Retirees should know a number of simple tax tips before retirement. Hi there, Kenner French with Vast Solutions Group, the nation's premier tax and financial engineering firm for entrepreneurs. Many times do clients come to us after retirement when it's too late. It sure would be nice if they were preparing for retirement, we were engaged and we can help them along the way. The federal government offers some major tax tips for older Americans. Some of these perks deserve more publicity than they currently receive. At age 65, the IRS gives you a larger standard deduction. For this year, 2020, standard deductions look like, this for 65 and older. Single filer or married filing separately, $14,500. Head of household, $20,300. Married filing jointly or qualifying widower, $26,100, especially when the spouse is 65 or older, or $27,400 when both spouses are 65 and older. The standard deductions for younger taxpayer range from $1,650 to $2,600 less. There are two situations when standard deductions may be limited at age 65 or older, and they disappear entirely. One is when the taxpayer claims you as a dependent. The other is when you're married and filing separately and your spouse itemizes deductions. You may be able to write off medical costs. The IRS will let you deduct qualifying medical expenses only once they exceed 7.5% of your adjusted gross income. The list of eligible expenses is long. Beyond out-of-pocket costs paid to doctors and other healthcare professionals, it also includes things like insurance premiums for extended care coverage, travel costs linked to medical appointments, and payments for durable medical equipment such as dentures and hearing aids. Are you thinking about selling your home? Well, listen up. Many retirees consider this. If you have lived in your current residence for less than 2 of the 5 years preceding a sale, you can exclude as much as $250,000 in gains from federal taxation. A married couple can shield up to $500,000. These limits established in 1997 have never been indexed to inflation. The exclusion only applies once every 2 years, by the way. How about low-income seniors? You may qualify for credit for the elderly or disabled. This incentive, intended for age 65 and up, can be as large as $7,500 based on filing status. You must have a very low AGI and non-taxable income to claim it, though. It is basically designed for those living wholly or mostly on Social Security benefits. Now, most of our clients are affluent. Listen up. Affluent IRA owners may want to make a charitable IRA gift. Generally, once you reach age 72, you must begin taking required minimum distributions, or RMDs, from a traditional IRA. You may not be looking forward to these annual withdrawals, especially if you're well off. You have another option. You can make a qualified charitable distribution, QCD, using those traditional IRA assets. You can donate up to $100,000 of traditional IRA assets to qualified charities in a single year this way, and the amount donated counts towards your required withdrawal. The amount of the QCD is excluded from your gross income for the year of the donation. Eligibility to make a QCD still begins at 70 and a half, that should be noted, even though the setting every community up for retirement enhancement, or SECURE Act, raised the starting age for annual traditional IRA distributions from 70 and a half to 72 years of age. It must be mentioned, by the way, that withdrawals from traditional IRAs are taxed as ordinary income tax, and if taken before age 59 and a half, they may be subject to a 10% federal excise penalty levied by the IRS. Of course, now, some states also give seniors tax breaks. For example, the following 11 states do not tax federal, state, or local pension income. And those are Alabama, Hawaii, Illinois, Kansas, Louisiana, Massachusetts, Michigan, Mississippi, Missouri, New York, and Pennsylvania. Now, 28 states and the District of Columbia refrain from taxing Social Security income. Now, unfortunately, your Social Security benefits could be partly or fully taxable, depending. They could be taxed at both federal and state level, depending on how much you earn and where you happen to live. Whether you feel this is reasonable or not, you may have the potential claim to some of the tax breaks mentioned above as you pursue the goal of tax efficiency. Once again, we prepare our clients at Vast Solutions Group before retirement. If you are before retirement, it's best to talk about these issues. If retirement has already occurred, please get in touch with us. Maybe we can help you or your professional and advisor to better your situation. If you have any questions, please go to the web, and we have a number of vital informational research items out there at www.vastsolutionsgroup.com, or call us at 888-808-8278, and we'd be happy to help you in any way possible.